Hello guys, welcome to Path Enlightened. This is Nikita here. Let me tell you something about myself. I have done my BCom honors graduation from Calcutta University. I have also completed my law from Delhi University. I have experience of 5 years of teaching. We will be doing today with auditing APFC exam, APFC UPSC. Let's start with it. First, we will dealing with introduction to auditing. Let me first tell you a picture of what all is about an auditing. So, auditing is to investigate the suspicious activity. It is about to monitor and gather data about specific database activity, and auditing is to examination of the records and reports of an enterprise by specialists other than those responsible for doing it. This is in small what audit is all about, and we will be dealing it with the details. So let's start with it. Auditing refers to a systematic and independent examination of books, accounts, documents, and vouchers of an organization to ascertain how far these financial statements present are true and fair, and it gives the view of the concern. Now, attempts to ensure that the books of accounts are properly maintained by the concerned as required by law. Audit provides third-party assurance to various stakeholders that the subject matter is free from material misstatement. Third parties are the ones who have bought the shares of the companies. Now, an unbiased examination and evaluation of the financial statements of an organization, it can be done internally and externally. Internally, it is done by the employees of the organization itself, and externally by the outside firm. Now, what are the features of auditing? Features of auditing are that audit is a verification of the result shown by the profit and loss account and the balance sheet. Profit and loss account is where the profits as well as the loss are recorded, and balance sheet is a sheet where the assets and liabilities are recorded. Now, audit is a critical review of the system of accounting and internal control. The auditor has to satisfy himself with the authenticity of the financial statement presented to him. Now, what are the developments in India? The Companies Act of 1931 made audit of company accounts compulsory. That means before the Companies Act of 1931, audit was not necessary for all the organizations should be done. Why it is necessary to do? Because of the increasing size of the companies and the volume of the transactions. The objective was audit shifted, and audit was expected to ascertain the accounts with true and fair picture. Now, hence the emphasis was not on arithmetic accuracy but on the fair representation. And for the first time, by the Companies Act, the qualifications of auditor has been given by him. Now, AAS, Auditing and Assurance Standard. Now, the Institute of Chartered Accountants of India, what we know, ICAI, was set up on 1949 to regulate the profession of chartered accountancy in India. One of the steps is the establishment of the Auditing Practices Committee or the Auditing and Assurance Standard Course, which is known as in September 1982, and their main objective is to issue auditing standards. Now, ICAI is a member of IFA, International Federation of Accountancy, which follows the policy of auditing standards issued by the ICAI with the harmony with the international standards on auditing. Now, what are the scopes of auditing? Long range objectives of an audit should be to serve as a guide to the management for future decisions. Auditor has to see whether these larger funds are properly used, encompasses verification of accounts with the intention of giving opinion on its reliability, covers cost audit, management audit, social audit of about which we will be doing later. An auditor is a watchdog but not a bloodhound. That means an auditor is a watchdog. It watches that the organization is performing in a fair and two-way. Now, legal requirements, entity aspects, reliable information, proper communication, evaluation, test, comparison, judgment, work, evidence, and misstatement. Now, what are the fundamental principles of auditing? First, integrity, objectivity, and independence. Number two, it is confidentiality, skill and competence, responsibility of work performed by others, documentation, planning, audit evidence, accounting system and internal control, audit conclusions, and audit report. Now, safeguard audit. It acts as a safeguard on behalf of the proprietors against cost control, carelessness, or fraud on the part of the proprietors, agents, or servants in the realization and utilization of their money and other assets. Now, assurance audit. It assures the proprietors' behalf that the accounts maintained truly represent facts and expenditure that has been incurred with due regularity and proprietary. Now, what is assessment audit? Assessment auditing assesses the adequacy of the accounting system. Now, review audit. Review audit credits the review of the financial statement to know whether the accounting records are in agreement with those agreements. Now, reporting tool audit. It is a tool for reporting on the financial statement as required by the terms of the auditor's appointment. Now, what are the limitations of auditing? Limitations of auditing are: audit may not give complete picture, problems of dependence, post-mortem examination, existence of errors in the audited accounts, diversified situations, existence of defective policies. The auditor can only report on the truth and fairness of the financial statement, but other defects he cannot report in that, like the defects related to management and the control may not be possible to be covered by the auditor. What are the phases of audit? There are 4 phases of audit. Phase 1, plan and design and audit approach. Phase 2 is to perform tests of controls and substantive tests of transaction. Phase 3 will be to perform analytical procedures and tests of details of balances. Phase 4 includes complete the audit and issue an audit report. Now, the main objective auditing. The main objectives of auditing is to detection and prevention of errors, mistakes committed unintentionally because of ignorance, carelessness. What are errors of omission? Errors can be of 4 types, that is errors of omission, error of commission, compensating errors, errors of principle. Now, errors of omission are those errors which arises on account of transaction. Errors of commission are those errors when incorrect entries are made in the books of accounts. Now, compensating errors are those where 2 or more mistakes are committed which counterbalances each other. Now, error of principle are those errors which are committed by not following the proper accounting principle. That means lack of knowledge. Now, types of audit. Types of audits are statutory audit, any audit carried on as per the requirement of law. Annual audit, an audit where the auditor verifies the account at the end of the financial year, that is on 31st March. Now, it is interim audit, is an audit conducted in the middle of the accounting year but before the accounts are closed, that is before 31st of March. Partial audit, it is an auditor is asked to audit only a particular part of the account system or not the whole. Now, balance sheet audit. Balance sheet audit is a kind of partial audit and is concerned with the verification of only those items which appear on balance sheet. And as I already said, on balance sheet, the assets and the liabilities of the company are written. Now, cost audit. Cost audit are those audits where cost audit is defined as the verification of cost accounting records, data and techniques for its accuracy and authenticity. Now, management audit. Management audit may be defined as a comprehensive examination of an organization's structures of a company and its plans and objectives. Now, continuous audit is an audit which goes throughout the year in the office at regular intervals. Now, this is all about today. Please subscribe to this channel for free education and also promote it among your friends. For further inquiries or suggestions, do mail us at pathenlighter@gmail.com. Thank you.